Good luck.
All right. Hi, everyone. Thanks for joining today. We're going to do a presentation. We have John Regan here from Avalara, and he's going to talk to us about the impact of South Dakota versus Wayfair on tax compliance.
Thanks, Shauna. I appreciate that nice warm welcome. Hey, everybody. I appreciate your being here. Today, I'd like to present this in a manner that is most helpful to you. So if at any point I'm going too fast, let me know. Too slow, don't be shy about telling me to hurry up. And any questions, just hit the question bar there or just speak up, and I can answer them as we go along. So what we're going to talk about here is sales tax. Doesn't sound that exciting, but last year we had something that actually thrust the subject of sales tax into the national consciousness, into the national awareness. It was a Supreme Court case. It was South Dakota versus Wayfair, and it changed the game as far as the rules around sales tax compliance. So it's actually kind of interesting. Sales tax will not be as boring as it seems to be on its face as we go through this, I guarantee it. So let's get into it a little bit. Our agenda will be covering 5 topics. The first is, hey, sales tax. What's the big deal about sales tax? And then we'll talk about that Supreme Court case that I mentioned, and that it introduced the notion or laws around economic nexus. We'll find out what economic nexus is all about. And then this might impact your company, so what can you do about it? And we'll talk about automating the compliance process and how that would work. And then we'll talk about an interesting section, interesting trends in accelerating the inevitable. So let's get into it here. We'll talk about sales tax. What's the big idea? What's the big deal with sales tax? Well, sales tax is important to state and local governments because it makes up such a big chunk of their incoming revenue. Almost half of a typical state's revenue is from sales tax. So states have a lot of things to do with their money, a lot of programs, a lot of projects, and they love sales tax because it's such a big chunk of the pie for them. Sales tax is so important that in this country, it's a statutory requirement. Statutory requirement sounds pretty important, doesn't it? Big, bold words here highlighted in orange. Well, you would think that a requirement would actually mean a requirement. Well, in reality, it's not necessarily that way. Companies don't necessarily choose to be compliant. In fact, companies do one of 3 things in this country. They fight it, they acknowledge that they have to be compliant to it, or they put their head in the sand, sort of the ostrich approach, and say, compliant? What? I've never been audited. Why should I worry? And they really don't pay that much attention to it, so to speak. So why is that? Why is something on one hand from the government supposed to be a statutory requirement, but not all companies treat it that way? Well, bottom line, sales tax is difficult. It's just plain hard in the United States compared to other countries. You know, say like in the EU, there's VAT. It's one tax rate. It's relatively simple. Not so in this case. And where does that come from? That comes from the fact that our country was born on states' rights. So states have the right to come up with sales tax rates and rules and implement them as they see fit, as long as they can get away with it, to bring that big chunk of sales tax revenue into their coffers. So sales tax is just plain hard.
Tell us why. Good grief. Hard.
It is hard. Thanks, Shauna. It's so hard, as a matter of fact, that 42% of the people out there would rather get a root canal than go through a tax audit. 48% thinks that a Rubik's Cube would be easier to solve than handling sales tax laws. 42%, again, almost half of the population, think that acing the SATs is easier to accomplish than mastering sales and use tax regulations. And 70% of accountants say that understanding sales tax compliance is the most difficult part of their job. It's just plain hard. And it's more than just tax rates. When I'm talking sales tax with you, the first thing that popped into your mind likely was tax rates. What's my rate? Do I have the rates right? Well, it's much more than that. And you would know this if you're involved in the compliance process within your company. First of all, there's nexus, which is your tax obligation to different states. We'll talk about it a little bit more in depth as we get into this presentation, but you need to know which states you're obligated to. You have to know where your product or service is taxable and where it's not. Product taxability is changing constantly. It's not a set thing. For example, a lot of services that didn't used to be taxable last year in certain states are taxable now. So taxability can vary from state to state. And there's jurisdiction assignment. If you looked at the sales tax jurisdictions across this country, it would look like one of those 1,000-piece jigsaw puzzles that you would have on your dining room table that would take you a month to put together. Well, it is difficult to deal with, period, because there's 12,000 of them. If you're doing compliance right and you're selling into all 50 states, you have to be aware of those jurisdictional boundaries. At any one point, 20% of those boundaries are in flux. So how do you keep track of that if you're one person or two people within a company trying to keep the company compliant with all that complexity in all those states? It's difficult. Then there's exemption certificates. If you're doing business B2B, you have to keep to manage those. And then you have to do the filing of the state and local tax returns, usually either monthly or quarterly. And you have to be ready for that audit. What if the auditor walks in? Are you going to have to tell them, I need to get back to you? Or can you just say, okay, here's access to our system for the next 24 hours. Go at it. Find out whatever you want. There are two different reactions to an audit. One is ready, one is not. So let's look at that compliance process that you may have within your company. That's a process that's often taken for granted. Companies think of it, traditionally as, hey, that's a cost of doing business. And that's where it ends. But there's a cost. There is a cost in doing this. Someone has to do all that work that I showed on the previous slide that's underneath the waterline. Someone has to do that, and they're not working for free. So a research firm, Wakefield Research, looked into this to try to quantify what is the cost of trying to be compliant manually. And for a small to medium-sized business, it's around $70,000. That's the time it takes for this person or this 2 or 3 people that they have to devote to this process, that they could be doing other, say, more productive things with. Then for an enterprise, it's probably a team of accountants, and they're racking up a bill of close to $400,000 in having to deal with this compliance process annually. But what if you get it wrong? Here's a statistic that always intrigues me. 3/4 of all CFOs will admit that if a sales tax auditor would be walking in the door, that he or she would likely uncover errors. So let's put this together now. 3/4 of all CFOs say that their company, their accounting team is not doing it right. But yet they're paying those accountants between $70,000 and $400,000 to do the job. Why? That doesn't make sense. Why would you pay someone to do a job wrong? Well, it relates to what I talked about in previous slides. It's difficult, and it's often just overlooked and considered the cost of doing business. But that doesn't make it right. What we have now is the ability with technology to move beyond this mindset and move beyond all the status quo and the old way of doing things, so that you actually get a return on your investment rather than a sinkhole in which your money's going. You're just being compliant to the government. What if we don't do it right? What if there is an audit? How do you quantify that? Again, a research firm has told us that over half of companies who get audited indicate that the cost of the audit is $50,000. That doesn't seem like much. I mean, to me, to a company, it would be a lot, but to a company, maybe not so much. But there's usually penalties and back taxes involved that push that number over $100,000. That's getting up there. So it's just not a fun process. In fact, almost half of all accountants who have been through an audit consider the experience more difficult than a divorce. And it's the gift that keeps on giving. Once audited, a company can expect future audits. So you just don't want to go there if you can avoid it. So let's dig a little bit into current events. We talked about that Supreme Court ruling last summer. Well, here's the basis of it. Previous to last summer, the rule around whether a company was liable or had nexus into a state, the obligation to pay sales tax and remit it, or collect sales tax and remit it into a state, was based on whether the company had a physical presence in that state. A physical presence was basically, do you have buildings, product, or people in that state? But over time, over the course of 30 years, a physical presence also included a lot of these other decision points. Did your investors have a board meeting in Texas? If yes, well then you have a physical presence. You have to collect and remit sales tax into Texas. This is states adding to the rules, changing the rules as much as they can to bring in more and more revenue from that big piece of pie they're getting of revenue that sales tax represents. So that's what it was before. It's a physical presence. So then this happened. The case, which is South Dakota versus Wayfair, said that the physical presence hurdle or threshold no longer exists. We're going to replace it with what's called economic nexus. What that means is your obligation to a state to collect and remit sales tax is no longer based on physical presence. It's based on how many dollars you sell into that state annually and how many sales you have into that state annually. So that's what South Dakota came up with as far as the thresholds for triggering economic nexus or sales tax obligation. Since that last June, I think we're now up to 36 states who have adopted economic nexus laws. Probably by the end of the year, it'll be pushing all of the states that have adopted this new way of defining sales tax obligations. So what are the thresholds from state to state? Well, most states just copied and pasted what South Dakota came up with. That's 100,000 in sales revenue annually into a state or 200 transactions into a state. Most states just took those and ran with it because the Supreme Court's already approved that. A few states are different. The point here, though, is a few states are different. You have to keep track of it all. And there's a trend right now that we're seeing where states that may have implemented economic nexus a couple months ago are now looking back on it and saying, that doesn't make sense for us. For example, California just announced their economic nexus laws April 1st. There's already talk of those laws changing. They may get rid of the second threshold, which is 200 transactions, and they may change the annual revenue to $500,000. So it's something that is in flux, and it's difficult to keep track of. So just be on the lookout if this is part of your responsibility, is keeping track of this. States in action post-ruling, the blue represents states that have adopted economic nexus. There's about 36 of them now. This next screen is a little more meaningful in that it shows the effect of the SCOTUS Wayfair ruling. A typical company prior, say a small to medium-sized business, prior to this ruling, might have had nexus based on physical presence in 3 states. They might have had a headquarters in California, a warehouse in Texas, and East Coast offices in Pennsylvania. So 3 cases of physical presence, 3 states that they're obligated to collect and remit sales tax. Now, when you go to post Wayfair, the effect is exponential here. It's a multiplier. In this case, almost 6 times the amount of nexus states, 6 times the amount of complexity is the result of the Wayfair ruling. So again, the Wayfair ruling says that the threshold is no longer a physical presence. It's based on how much sales revenue annually and how many sales you have in each state. So that same company now has 17 states that they need to be compliant to rather than 3. The net effect of this for a lot of companies, it blows up the compliance process. You know, as I talked about earlier, that compliance process is difficult as it was. Now, if you make it exponentially more difficult, what do you do? How can you keep track of that? So many CFOs and controllers are looking at this process and they're saying, I can't handle this anymore. I could hire maybe more staff members or move more staff members over to handle the process. But what does that get me? This process brings me no revenue. So I'm incurring new costs, or I'm diverting accountants that are doing tasks that do bring value. I'm diverting them to something that doesn't bring value. It doesn't make sense. So a lot of CFOs say, okay, this is the turning point. This is when I really need to look at automating this process to outsource it. This slide pertains to companies that are doing business B2B. Now remember, if you're doing B2B, your tax obligation is not about collecting and remitting tax, because you don't have to do that. It's about proving why you didn't, why you're exempt. Many companies overlook the importance of this requirement, and they don't realize that exemption certificates are the same thing as cash. Missing just one could cost you thousands of dollars in an audit. Bottom line, the effect here of Wayfair has to do with the individual states' economic nexus thresholds. Some states include both B2B and B2C sales in their thresholds. It's not just B2C in probably a dozen states. So that would trigger nexus in states where they're B2C, where they have B2C sales, where they didn't previously. So a company has to register in those new states. And that brings along a whole set of headaches that the accounting department likely has never dealt with before, and could be pretty much of a nightmare to handle. So if you're doing business to B2B, don't assume that the Supreme Court ruling doesn't affect you, because it likely would. So what do you do about this? Well, we recommend 3 steps to readying your business for economic nexus. First of all, what is your nexus? You need to recalculate that. And I can help, or your CPA can help. We have a wizard that you can walk through and look at which states you exceed the economic nexus rules, and then it determines where you have nexus. And we could provide a nexus analysis, which would go a little bit more in depth. And your CPA could do that as well. Then you need to revisit registration, because you'll probably have new nexus coming out of the Supreme Court ruling. You could register in the states, or again, you could have an outside party do that, and Avalara has that service as well. And then you want to, like I said 2 slides ago, rethink compliance. You want to ask yourself, is there a better way now that compliance has become so difficult? Avalara can help. We provide these professional services. I mentioned a nexus study, a sales tax registration. If you get into a situation where there's back taxes due to a state, you might want to have Avalara represent you. We could go into the state and try to help you negotiate down that tax bill in return for your registering into the state. So we help companies in a very bottom line way with that service. We can help you with tax recovery, back filing, claims for refunds, pretty much the whole gamut of anything you would need service-wise we can provide. And like I said, you may want to look at the future and do we want to have this process in-house? How can we handle it in possibly a better way? Well, here's how it works if you want to use cloud computing, for example, Avalara, to take care of it, to outsource, to automate the entire process. It starts over here on the left. You have an ERP or a shopping cart that's generating business transactions, sales. Each one of those transactions needs to be mated with a tax rate. So how's that work? Well, at the time the transaction is created, the data travels up through our connectors. We have over 700 now certified connectors. The whole NetSuite suite is involved here. We have pre-built connectors for everything NetSuite that goes through the connector and travels up to the cloud. We have software up there called AvaTax. And within AvaTax, we keep track of all of the jurisdictional boundaries, the taxability rules, and the tax rates. We keep them all up there, and we have a staff of 100 monitoring all of that across the nation. That's not a job that bless them, because that's not a job I would want to do. I'm not built for that. But they're keeping track of all that, so our customers don't have to do that. It's always up to date. So what happens, those transactions hit Avatax. They knock on the door and say, hey, Avatax, I've got this purchase that's in this state. It's shipping to this state. It's for this particular product for this company. Tell me if I got the address right. So we'll go through address validation, and then Avatax will look at that product and say, with all these factors, here's whether it's taxable or not. Is it taxable? Is it not taxable? Is it partially taxable? Or is there a tax holiday? In certain states, there are tax holidays that we have to keep track of. So it brings that determination into the next stage, where it looks at the tax jurisdiction. And it says, okay, within this jurisdiction, which tax rate applies? And that's how it gets to the tax rate. And all that happens in the blink of an eye, less than a second. And that tax rate then is sent down to with the transactional data. And now you have a complete sales transaction that has a tax rate with it. So all that's pretty cool. All that is what most companies think of that we would provide, but it goes beyond that. What we do beyond that is we handle the returns process, returns filing. We have all that transactional data up in the cloud, so why don't we make good use of it? When it comes time for a company to do their sales tax filings, usually monthly or quarterly, we'll send that information down into a liability worksheet. And what that breaks down for a CFO or controller is all of the sales tax obligations that the company incurred during that filing period, broken down by jurisdictions in which they have nexus. So it takes a lot of work out of the accounting department's hands. Work that used to be done on spreadsheets and conglomerating different spreadsheets together to get to a final spreadsheet that takes time and it is quite error prone. All that is gone because we can chop and dice the transactional data that we've received for the tax period any which way to provide a liability worksheet and many other views of the sales tax obligations. So what a CFO or controller can do is simply hit the go button, and then we can take all of the funds that are owed to each jurisdiction and send them electronically through ACH accounts that we have set up. And we can also send the filings electronically. We make the data for each jurisdiction where there's monies owed, along with the jurisdiction's tax forms electronically, and send it. So we can take care of this whole process from end to end. So this is the beauty of cloud computing. A company no longer has to worry about handling this process manually. It's all outsourced. This is an interesting section. It's right as we come to the end of the presentation here. I want to talk about the trend that's involved with this technology. Interesting stats here. By 2022, just 4 short years from now, adoption of compliance software as a service will grow by 40 times. Now imagine if your customer base grew 40 times in like 4 years. That's an incredible growth rate. Why is that? Well, it's because we have this new technology, the cloud computing, that we can leverage. This is an application that is one of those, this just makes sense applications. It's what we call an inevitable solution. By 2022, as many companies will be outsourcing tax compliance as currently outsource payroll. This is really similar, if you look back, to the adoption of payroll among American business, the idea of outsourcing payroll. When that was adopted back in the 80s, before that, companies did payroll in-house. And it was similar to companies doing sales tax compliance in-house, in that both processes bring no value, both processes waste valuable accounting resources, and if you get both processes wrong, you could get in trouble with the government. So they're similar processes. But back in that day, ADP came into the marketplace and said, hey, why or are you doing this in-house? For all these reasons, you should automate the process, outsource it. And the idea caught on because that, like sales tax compliance automation, is a common sense idea. So now you'd be hard pressed if you walk down the street and knock on doors to companies to find one that doesn't outsource payroll, right? Well, that's exactly what's happening with outsourced tax compliance, but at a much faster rate due to technology and the advancements we've made. So who's leading the way here? It's top performing companies. They're 3 1/3 times more likely to adopt compliance SaaS. Those companies just happen to be the same profile as companies that use NetSuite. The bottom line here in accelerating the inevitable are a few quotes, a few points to ponder. Any effort spent on tax compliance is non-revenue generating. Manual tax compliance defined in 4 short words: no reward, high risk. Why would any company want to have a process under their roof that can be defined like that? The Supreme Court ruling makes an already burdensome compliance process exponentially more complicated, leading to increased audit risk. And finally, Jack Welch put it well when he was CEO of GE: do what you do best, outsource the rest. So all that being said, any questions?
So we've got a couple questions here, if you're ready.
Sure.
Here's one. How did the Supreme Court ruling, how did that affect Avalara in the way that you do business?
That's a good question. Obviously, it's a boon to us. We're setting sales records monthly. Luckily, we were in a position to be able to take on this new business. I mean, sure, we knew that there would be business resulting from this, but we didn't know that it would be such a tidal wave like this. And we've had to adjust and add more people to certain departments, like our Go Live department and our support department. We're staffing up in a big way for that. So our Go Live implementations have been delayed for a week or two. But when you think of it in the bigger picture, our Go Lives are usually measured in weeks, not months or worse. This is a relatively easy implementation process because we have over 700 connectors already built and certified, including all the NetSuite offerings. So implementation is a breeze compared to like a wide-scale ERP implementation. So it's been delayed a little bit. Within the next 4 weeks, probably we'll be back to normal in our Go Live and support areas. But we look at it as a boon. Luckily, we've been in business for 15 years, and we had, over that amount of time, the opportunity to take a look at all of our processes. And at Avalara, being a cloud company, we're very process-driven. We've been able to look at all of our processes and constantly refine them and change them, keep them up to date, and constantly refining them. So our systems overall, could handle the wave, and we're built for it. So luckily that's the case. You may find out that isn't necessarily the case with all companies in our space. The longer you've been in business, the more you can handle a wave like this. That's what I'm saying. So hope that makes sense.
Yeah, thank you. We have 2 more questions, if that's okay, that are coming through. So
sure.
One of them is, what does the integration look like between Avalara and NetSuite?
Okay. Like I said, it's pre-built, pre-certified. I think we have close to 2,000 integrations on the books now with NetSuite customers. So what it looks like, it's kind of more of a high-level question. I don't want to get into the detail. I'm an alliance manager, so I'm not the best to get real technical about it. But it works similar to that chart that I showed earlier, where it just travels through the connector up to AvaTax and comes back down. We do have, I didn't mention this, but we also are connected with B2B companies, and NetSuite handles this very smoothly compared to a lot of our other connectors. NetSuite is the cream of the crop as far as how tax-exempt sales are handled. NetSuite can communicate with our offering cert capture to make sure that there is an exemption certificate on file and that it's up to date and correct for any one of those exempt certificates. So the best thing I can say about that integration is that it's solid. It's been around for a while. I never hear issues about there being technical problems with it from my partners. So it's solid in that regard. I hope that answers the question.
Yeah, I believe it does. And then finally, we've got one more question. So Suite Tax. So that's a new piece of functionality that NetSuite's rolling out. And we're getting a lot of questions about that. So how does that affect Avalara, and how does that work together?
Sure. We tie into Suite Tax. We have a connector, AvaTax for Suite Tax. So what you get with Suite Tax is really, well, let me explain it through what it can do. What it does is it looks at a transaction and comes up with the tax rate by using zip codes. It doesn't look at a transaction as AvaTax does and use literally latitude and longitude technology to find out exactly where the ship to is down to the rooftop. That means you're right down to, you go sort of inside out. You're going rooftop to tax jurisdiction to tax rate, if that makes sense. With Suite Tax, you're looking at it's using an older way of doing things. It's not using latitude and longitude. It's looking at zip codes, and zip codes weren't made to connect businesses to the correct tax rate. Zip codes were made to get the mail delivered on time. But back before cloud computing, that was the best way to try to figure out what the tax rate is, was to try to use zip codes as a basis. So what happens is there's a chart that has two columns, and it has a zip code on the left and it has a tax rate on the right. So if your sales transactions ended up in that zip code, the software would then cross-reference the correct tax rate, and that would be your tax rate. Again, the old way of doing things. The problem there is, with any zip code, there can be multiple tax jurisdictions with multiple rates. So the rate that is assigned to that particular zip code in that chart that I was talking about is sort of like a round figure. So you could have tax rates within that zip code that vary from 7% to 10%, and the assigned tax rate within this software might be 8%. So you're close. You're not accurate. And so the question becomes, in the case of an audit, is close enough good enough for an auditor? And that's up to each CFO or controller to decide whether close enough is good enough, if you want to take that risk. So bottom line is, with Suite Tax, you're not necessarily getting correct tax rates from it. And then another important thing, and I talked in previous slides about it, is taxability. Where is your product taxable? Where is it not taxable? Where is it partially taxable? And how is my taxability of my product changing? Those are all important considerations that someone needs to keep track of. Suite Tax doesn't have the capability of that, to do that. Your product or service is either taxable or not taxable. So again, as far as a taxability decision, you might not be getting correct information from Suite Tax. Suite Tax is good if you're, in my opinion, a smaller company that might be selling a product locally or regionally. Once you go outside to the states and you start incurring nexus obligation in other states, Suite Tax becomes less and less of a good fit for your tax compliance requirements. So what AvaTax for Suite Tax does is come in and it fills in the gaps where Suite Tax stops. So we take the tax rate and we use newer technology to come back with the guaranteed correct tax rate, and then we have taxability rules that we monitor all the time, so that the decision about taxability is always correct. So it adds those levels of sophistication, so to speak, to make sure that you're doing it right. So that's what AvaTax for Suite Tax does. Any questions on that?
Doesn't seem to be. Okay, so those are all the
Okay.
questions we do have. I guess we'll just wrap it up. We're coming to the top of the hour if no one has any more questions. John has his contact information at the end of the deck, and we'll be sending this recording out to everyone. You can also reach out to myself, Shauna McPhail, at Cumula 3 Group. So I will send my information out as well when we send out the recording. Thank everyone for joining. John, thanks so much. We really do appreciate your time today.
Thank you, Shauna. Appreciate it.
Awesome.
All right. Thank you.